Reg A is more focused on a mass publication where you can bring on a variety of investors, and Reg D is more focused on accredited investors. I mean, at 506B, you can actually raise from non-accredited investors. If you have had a pre-existing relationship with them, it maxes you at 35 non-accredited investors and as many accredited investors as you wish. Syndicating deals, there's a lot of different ways you can fund a deal that you have, especially if you're looking at, let's say, short-term rental, which is a business model that I always recommend for people who want to get into real estate investing. Aside from buying a home and just renting it out long-term, is getting involved in short-term rental, which allows you to, it's much more dynamic. There's a lot more moving parts, allows you then grow your portfolio from there.
My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey, everybody. Welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and joining us today is August Biniaz, co-founder and chief investment officer at CPI Capital. With over 15 years of real estate experience and more than $225 million in multifamily deals under his belt, August is a leading voice in commercial real estate investing and hosts the popular podcast, Real Estate Investing Demystified. And recently, he completed the private equity and venture capital program at Harvard. August, welcome to the show.
Hi there. Thank you for having me.
I'm excited about today's conversation because we're going to talk a little bit about private equity. And I've got my own fund. I've got my Blue Fusion Capital, which is a private equity fund that does a lot of investing in short-term vacation rentals. And a lot of people ask me about the structures and the fundamentals and how to set it up and why do you do it? And I've got the guy today who's going to walk us through all that. Not just walk us through it, he's going to talk us through it, going to help us kind of sort it out and talk about why and how you do this. So, August, if you could just tell people a little bit about your background.
Yeah, absolutely. I'm August Biniaz. I'm the chief investment officer with CPI Capital. CPI Capital is a real estate private equity firm with its mandate to syndicate deals, mainly focused on U.S. real estate, focused on multifamily value add and build to rent, BTR. Our target markets are in Texas and Florida. Yeah, that's a bit about myself and the company.
No, that's great. So in terms of private equity, I know that a lot of people, it seems very big. It's a big topic for people. Some people get a little intimidated by talking about it, but we can really kind of break it down. It's not as hard as you might think it might be to set up, say, a fund or to go through the process. Can you kind of give people a little bit of an idea about, number one, let's talk a little bit about when this became a reality where we could set up these types of funds, because this is not very old, where the government came in and allowed us to start raising money through this type of funding.
Yeah, no, of course, you're talking about the Jobs Act in 2013 that made it a lot easier for people to advertise and promote these offerings, and ended up being kind of the wild, wild west initially. And then, a lot of people using great marketing efforts, and people like Grant Cardone who use their marketing paralysis to be able to raise hundreds of millions of dollars and put these funds together. And, it made it easier for people to get involved in the private equity space. Historically, private equity was reserved for large institutions, the Blackstone, KKR, Apollos of the world. And private equity started initially with buying companies. So Blackstone started out as a leverage buyout shop, and that was a way to be able to, a savvy way to be able to buy companies, borrowing debt to do so. But the business model is the same. When you buy a piece of real estate, you want to create, you want to make yield, you want to make the business, execute your business plan, make the asset more profitable, and then exit it at some point. Private equity was the same concept but with companies. Interestingly enough, after a point, Blackstone actually ended up having a larger allocation to real estate than they did to private equity. Today, they have a larger allocation to private debt than they do to real estate and private equity. But that was kind of the start. But yeah, today there are a lot of law firms and advisors and mentorship programs that allows everyday people to try to get involved in the space. There is somewhat of a survival fallacy where you see that a lot of success that has happened, but there's a lot of people that don't succeed this as well. The cream rises to the top. But overall, private equity is just a concept of being able to raise funds, raise money without having to go to the public markets, going through the IPO route. There's ways, you need to have offering docs. If you're using, for example, the 506C offering allows you to have offering docs where you provide those to the investors and investors can invest, and it's makes the process. I'll stop there. Maybe you have some other questions.
Yeah, well, I'm curious because you talk a little bit about the documentation, and I know that there's different forms, there's different ways that people can go about raising money because some people don't need as much money, or maybe maybe somebody picks a Reg D over a Reg A. With the Reg D, of course, you're getting into that more accredited type investor, where you get to the Reg A, where you can open it up to people who are not accredited. But I would also say there's a big difference in the compliance when you're talking about what you have to file, what you have to show, what you have to do in a Reg D versus a Reg A. But maybe you could talk a little bit about the comparison of the differences between those two types of funds.
Yeah, I think you touched on it. Reg A is more focused on a mass publication where you can bring on a variety of investors, and Reg D is more focused on accredited investors. I mean, in 506B, you can actually raise from non-accredited investors if you have had a pre-existing relationship with them. It maxes you at 35 non-accredited investors and as many accredited investors as you wish. But yeah, there are lots of nuances there. I wouldn't want to give the caveats that I'm not obviously a securities attorney or what have you. But yeah, I mean, syndicating deals. There's a lot of different ways you can fund a deal that you have, especially if you're looking at, let's say, short-term rental, which is a business model that I always recommend for people who want to get into real estate investing. Aside from buying a home and just renting it out long term, is getting involved in short-term rental, which allows you to. It's much more dynamic. There's a lot more moving parts. Allows you then grow your portfolio from there after having short-term rentals. But in a case of, let's say, you want to have a short-term rental portfolio, you can initially start bringing on possibly joint venture partners. Now you're not triggering compliance issues. You don't have to go put together a fund, which is somewhat, there is lots of compliance items and there's a cost in having an ongoing fund, or even a syndicated deals where it's a project specific fund. Again, there's moving parts there, but you could bring on joint venture partners and, in a LLC, and you can have different roles and responsibilities, which allows you to still raise money and not have to go through the regulatory framework and, the hoops to have to jump through.
When did you put together your first deal?
My first deal, I was a home builder for a long time in Vancouver, Canada, and the west coast of Canada. And I always looked around my space and I saw, high rises being built and big housing projects being built. And I always wondered how those deals were put together. That was my dream eventually, to move from being a single family home builder to be a large developer. I just saw it as very unattainable. And when I looked around my space again, I saw that people who were able to do that, they were either large institutions or they were families, multi-generational families that were now at a stage that they could build these larger projects. I always saw my limitation as how much equity I had access to. But after I found out that there is a process to raise money, this was around 7 years ago when I found out that there is a process in raising money, and I went down that rabbit hole of the world of private equity and the world of funds and syndications. I really fell in love with the model, really fascinating world. And what also it did, it changed my business plan. So rather than being focused on trying to build a high rise or a housing community here in Vancouver, a lot of my information I was getting about putting together these funds was coming from the US, and many other new business ideas came to fruition, like ideas that I'd never seen before, like multifamily value add or build to rent. And I felt that being a firm here in Canada, it gave us a competitive advantage to be able to bring US real estate, which had much higher yields, to Canadian investors. And that was kind of the start of us. But the first deal ever was a deal that I was kind of the initial kind of start was a townhome development here in Vancouver. It was a deal that came across my desk. I didn't have the equity to buy the deal, and I took it to a few partners, and we were jointly able to fund the project and put it together. So that was kind of my start in how these deals are done: joint venture, syndications, funds.
Yeah. When you talk about joint venture, you think about any fund. I mean, some people go, I'm going to raise money. I'm just going to have all these people put their money in, and I'm going to go do kind of whatever I want. But the thing about it is when you think about investing, I mean, these people that are coming onto your cap table, that are investing in you, investing in your company, investing in what you're taking their money out and investing in. I mean, I kind of look at those people more as like just partners, as people who I need to get up every day. I'm not just responsible for myself anymore. My losses are now potentially somebody else's losses. My gains are now potentially somebody else's gains. So there's a lot of responsibility, although there's a lot of opportunity that comes with starting a fund. There's also a lot of responsibility to so many different people that hit your cap table once you start raising those funds.
Of course, you become fiduciary to your investors, and also brand and reputation as well. You're, as a fund manager, you're just as good as the last fund you put together or last deal you did. So it's that's another component of it. It's the yields you were able to achieve for your investors, the reputation that you have, the communication you have with investors. Because the best way to gain investors is through referrals. So yeah, no, great point you touched on.
Yeah. So when you're sitting there, let's take a little step back. So a lot of the folks that listen to the podcast, maybe they've got a few vacation properties. Maybe they're looking at getting into some vacation properties, um, and this might sound very big to them. They might be sitting there going, "Oh my gosh, he's talking about Grant Cardone. Oh my gosh, he's talking about putting together multi-million-dollar deals." It's not that far out of reach for these folks, so that are coming in or maybe are in it right now to start putting together their own funds. Correct?
Yeah, absolutely. I mean, again, like I touched earlier, there's lots of work that needs to be done. So last thing you want is put together a fund, but never to launch, or for it to launch and for it not to be profitable. So one advice is, if you are in, let's say, a certain asset class, like we can use short-term rentals as an example, and you're looking to start a fund in that space, my number one advice is probably invest as an LP in an existing short-term rental fund.
Mm.
That way, you can see how these funds are structured. You can see the communication that the fund manager is providing. You can see what you love about it and what you don't, and eventually you can possibly launch your fund. Second thing would be joining a mastermind or a mentoring program that assists people in trying to put these funds and syndications together. That's another great way of connecting with other individuals. And then next would be putting together your team. If that's internal, if you want to, if you're great at underwriting and analyzing deals and spreadsheets, and then you need a partner who is great at, possibly raising money, or if you need a partner who's great at going out there and acquiring deals, or you need a partner that's great at managing these properties or overseeing the property manager. So you want to build your internal team. And even if you are not out there hiring people or partnering with people, it's great to understand who are these individuals that are going to come and build your company. And then in parallel, you need to build your external team. That's your securities attorney, your corporate attorney, your accountant, bookkeeper. You need to have kind of a long-term vision if you're trying to put the fund together, because the moment you raise a single dollar from investors, there's compliance issues, there's regulatory issues, there's accounting. You're a fiduciary to these investors, and you can't walk away. Now you're married for at least the term of the fund. So a lot to think about. Is a great business to be in, and especially if you gain some momentum, it could be very profitable. But a lot of groundwork and education needs to be done.
Yeah, you said you used the word married, and that is a perfect word to define. And it's not a short-term marriage. I mean, like you said, it's usually the term of the fund. So if you get a 7 to 10 year hold, I mean, you're going to be married to these investors for 7 to 10 years, and you have a fiduciary responsibility to each one of them for that period of time. So it's one of those things where if you're going to go into it, you need to be sure that you want to go. It's just like getting married. You want to be sure that you're going to say "I do" when you go to the altar, because, oh yeah, 7 to 10. I guess my first marriage lasted about that long, but my second one's gone way further. But as a fund, you want to just make sure that you've got things lined up, and it really aligns with who you are and what you want to be doing.
Absolutely. And talk to the fund manager. I mean, like, my first recommendation was invest in a fund, but talk to the fund manager and see how much time they have to invest in running this company. If your if your perfect day is a day that, you're working a few hours and it's a 3-hour work week, and the fund manager that you've invested with or you're getting guidance from, the guy is working, 10-hour, 12-hour days, and he's working on the weekends, maybe that's not the best way to do it. Maybe you can live a perfect life from just being a passive investor or owning a few short-term rentals. So look at it from that angle as well.
Yeah, I guess it's all about your goals, who you are, what kind of lifestyle you want. I mean, how big do you want your portfolio to be? Do you want to share that? I mean, sometimes you got to look at it too and go, again, less people on a cap table can be better, right? So if I'm going out and I'm going to go, okay, maybe I'm going to look at a Reg A and I'm going to bring on, you know, 500 investors onto my cap table, you got to be ready for a lot of I don't want to say issues, but a lot of people asking a lot of questions. There's just going to be a lot of maintenance to 500 people on a cap table, as opposed to if you go like a Reg D and you've got these people who are investors who uh, put in a significant amount of money as compared to what's happening in a Reg A cap table, then you just got to kind of weigh out what's important to you. How much time do I have? How much time do I want to spend? How much brain damage do I want? And then say, well, do I want this? Or maybe I just keep my own portfolio and I'm responsible to one person, being myself. Hey, everybody. I hope you're enjoying this episode of the Vacation Property Secrets podcast. I want to let you know about one question that I get all the time. And that's, how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that, or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertyexpertnetwork.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertyexpertnetwork.com.
Absolutely, and as you build a private equity firm, the burn rate goes up. So you're going to bring in different employees, different contractors, and the maintenance cost goes up. So you're looking at sometimes a $500 to $1 million burn rate for a boutique private equity firm. So you're responsible to a lot of people there. And when we talked about investors, these investors don't just appear, right? Be it Reg D or Reg A, be it a handful of high net worth investors or a bunch of accredited or even potentially non-accredited investors. The process of gaining investors and nurturing those investors and the communications you need to send, that's a whole different world of itself. I mean, we can touch on it a bit as well. Coming to the space without, some people might have a very wealthy uncle or a family or friends, but at some point that money is going to get tapped out and you have to go to the members of the public. How are you going to achieve that? How are you going to do it while staying compliant? How are you going to convince someone to come and sign a 150-page document to, send you $50,000 saying that if you lose all their money, they can't do anything about it and you have full control and they have no say? That's a big ask. That's not selling a service or a product. That's offering a partnership.
So, August, you're telling me this isn't necessarily an easy road.
It's not easy. Like I said, if you gain momentum and traction in this space, the sky is, the sky is, there's no limit. I wouldn't even say sky is the limit because Blackstone today has $1 trillion of assets under management. That's just mind blowing, right? 1,000 billion. BlackRock, which was an offshoot of Blackstone, has $10 trillion of assets under management, is measured as a bit different. So in the case of BlackRock, the funds that they manage for others is also part of their AUM, whereas Blackstone is actual properties and the companies that they own and the debt funds that they have. But those numbers are unthinkable numbers at some point, $1 trillion of assets under management. So, it's fascinating world, but there's a lot of work. So, and you're competing with Harvard graduates, some of the greatest minds in the world. So it's exciting and it's humbling. But yeah, everything starts with possibly being an LP, investing in a fund, see how it goes, and then the next step is doing some joint ventures, buying a short term with a few of your partners. Maybe it'll be so straining you might not want to continue, but you might actually feel like you're really good at it. So it goes from being an LP, buying a property yourself, whatever asset class you believe in, managing that, eventually bringing on a couple of joint venture partners, see how that goes. And as everything is going well, then the next step is putting together a syndication, which is a step between a joint venture and a fund. Whereas look at it as a project specific fund. So your offering docs, your marketing material, your pitch is on one deal. That deal could be a handful of short-term rental properties. So it's not like an evergreen fund where you continuously raising money for a term and then you execute a business plan and you're exiting the fund. It's more project specific.
Yeah. And I would say too, the toughest one is fund one. And I'm going to get your opinion on that too. But, for me, it's kind of like you don't have that track record that you're talking about. You haven't gotten into the marketplace and proven yourself. You go to these family offices and they're shaking their head because they don't know you're unproven at that point. But I feel like if you go in, if you're really successful on fund one, fund two becomes much easier. Fund three then gets much easier. Is that how you've been seeing it?
Absolutely, no doubt, no doubt. Again, the term fund gets thrown around a lot, but in the real estate context, a fund is historically just any entity that holds funds. Like you can say college fund, for example, right? But in the context of real estate funds, is you either got evergreen funds where you're continuously raising funds and continuously buying properties, executing the business plan, and providing dividends to your investors. You got publicly traded funds, private funds. But you also have a fund, which is potentially a syndication. So a syndication is considered a fund as well because it could have one deal in it, it could have multiple deals, but it's the offering material and the fund is for that particular project, be it a single project or multiple projects. So, yeah, I mean, again, my advice goes back if you're trying to get people to invest with you and uh, trust you with their money, you need to have your own track record initially. You have to have, okay, you believe in short-term rentals. Have you ever owned a short-term rental? Have you ever managed one? You were trying to put a $10 million fund in, and you want me to invest $250,000 in it. Great, I trust you, I like you, but you've never managed a short-term rental property. So I would say that's the initial hurdle, and it's a learning lesson as well. It's great to be able to manage this this property and see that do you really believe in the asset class aside from what you've read or the information that you've consumed.
How does compliance compare with the syndication versus, say, a Reg A or a Reg D? Is it, I mean, is it less stringent? I know that, I've got a Reg, mine's a Reg A plus, and when I did it, I kind of look back and I go, I almost kind of wish I did a Reg D. But the thing about it was I had so many people that have encouraged me and wanted to invest in what I do for so long, but I didn't feel like they were going to be able to invest if I did a Reg D. I didn't think they were going to qualify, under Reg D. But I never really thought about syndication. But by the way, for me, the Reg A plus, there's so much compliance there. I mean, there's so many things that you're doing, the annual audits and the SEC filings and all the requirements. And of course, when you're raising money, all the state blue sky filings and such. Is the syndication a little bit easier of a process?
Definitely it is. So there is no audited financials required in the syndication. And you're somewhat a non-reporting issuer, so you don't have to do annual reports or what have you. You do have to draft offering docs, and those documents have to be provided to investors. If you're using the 506C, for example, the accredited investors who come and join your syndicated deal and invest with you have to be verified by a third party, being an attorney and a CPA or some of these platforms that verify investors. Well, actually, one of them is called Verify Investor. When it comes to the offering documents and the compliance when it comes to a syndicated deal or a fund, they're actually very similar. It's just the mandate of the fund changes. In a syndicated deal, the mandate is purchasing that property, executing the business plan, and exiting, and then wrapping up the fund. Whereas in a fund is a bit longer horizon where you might be purchasing multiple properties, executing the business plan, and eventually wrapping up the fund. So they're very similar, just different mandates.
Yeah. No, that's interesting. And I'm gonna take a closer look at syndication because it's something I have not done yet. But there's always that one deal that comes through that you go, oh man, that'd be a great if you could get a group of a few people to come in on this and syndicate it out. It would be a great return or it'd be a great property to have. Um, in terms of your deals, are you doing more syndication type deals?
We are. So every time we have a deal, so all the deals that we invest in are in the US, in Texas and Florida. But when we have a deal under contract, we go ahead and create a project specific fund. And that's just a limited partnership. So we create our US limited partnership, our US, as we call it, a US master fund, project specific US master fund. Currently, we have a deal under contract in Dallas. It's called Apollo Meadows. So we create a US master fund for Apollo Meadows. And then in parallel with that, we create a Canadian feeder fund. So we create our Canadian fund, which is our Canadian feeder fund. So our Canadian investors invest directly into the Canadian fund. Our US investors invest directly into the US fund. There's separate offering docs, obviously. There's separate regulatory framework we have to follow and the exemptions that we use on both sides of the border So in the US, we're going to be using the 506C exemption. In Canada, we're going to be probably using the accredited investor or private issuer exemption. We have to make sure that they both comply. And then we go ahead and start raising funds. Now, after we've completed raising funds from our Canadian investors, that Canadian feeder fund becomes an individual investor in the US master fund in parallel with our other investors who've invested directly into the US master fund. So hypothetically, if we end up raising $2 million from the Canadian fund, which is comprised of, let's say, 20 investors investing 100,000 each, I'm just using hypothetical numbers, that $2 million that's raised from the Canadian fund, the Canadian fund invests it into the US fund as just one check. So there's just one K1 provided to the Canadian fund. We've structured our cross-border fund in a way that our Canadian investors don't have to file U.S. taxes. That was a big pushback we got on our first few syndicated deals that we put together. Canadian investors like, hey, we're already dealing with the CRA, Canada Revenue Agency. We don't have to now deal with the IRS. So we structured our organizational chart in a way that Canadian investors are relieved from having to file U.S. taxes. The partnership actually files on their behalf. And then we also have, in parallel with these syndicated deals, these project-specific funds, we also have our Canadian, which is in Canada, it's called a mutual fund trust, which is our Canadian evergreen fund, that investors in Canada who want to use their retirement accounts to invest, they can use the fund to invest into separate deals. So unlike the US, where people who have retirement accounts sitting in their 401ks, IRAs, they can self-direct those into a syndicated deal, and that syndicated deal can be structured in a limited partnership, in an LLC. In Canada, you are also allowed to self-direct your retirement accounts, which is called RRSPs, RESPs, TFSAs, but the entity that the deal is structured in cannot be a limited partnership or a corporation. It has to be this entity, which is a mutual fund trust, which is much more complicated. It's very similar to your Reg A, where there's audits that are needed. There is annual filings and reportings that are needed. So that's really the web of corporations and limited partnerships and mutual fund trusts we utilize to be able to bring on international investors, in this case, be it Canadian investors, to invest in our U.S. syndicated deals.
August, I have to ask the question. I mean, are there any hurdles coming with this current administration that might change the way that you have to do business?
Yeah, I mean, the current administration, obviously, there's been tariffs slapped in the face of Canada now, back and forth for a few months. That has resulted in a lot of, not only on the economic side when it comes to investors or people looking to invest in the U.S., it is also a personal sentiment and pride related concerns and issues. I saw a stat in the news today that there has been a 30% reduction for a year over year from June 2025 compared to June 2024. There's been a 30% reduction in Canadians driving to the US. And there's been a 22% reduction on the same year over year month for people flying to the U.S. So with us at CPI, we've had a 20% reduction in the number of Canadian LPs investing in our deals. Historically, we've had 70% of our funds coming from Canadian investors and 30% coming from U.S. investors. On our last deal, Apollo Oaks in San Antonio, that had dropped down to 60% Canadian investors and 40% U.S. investors. We also, another item that we track, another KPI that we track is also soft commitments. So maybe we have a deal, we package it up, we create our marketing material, we have an investor webinar, and we send it out to our investors. And investors have the opportunity to soft commit before our offering docs are ready and they can actually make their investment. That secures their spot. Historically, when there's a soft commitment made by investors, we usually have a 10% drop-off rate. So 10% of people who soft commit don't end up completing their investment for whatever the reasons are. Maybe their personal situation changes. Maybe the deal doesn't make sense for them. In our last deal, Apollo Oaks, we had a 50% drop rate of people who soft committed.
Oh,
and
wow.
compared to people who made their completed their investment. Now, there was a lot of interest, so we raised the funds in the needed time. There was a lot of investor interest, but that number was really, it was mind blowing about. And when our investor relations team talked to investors, some of them are saying, I'm not even traveling to the U.S., let alone wanting to invest in the U.S. So, but Canada is a close trading partner of the U.S. I think this is just a little, little argument amongst friends. I think it will come back around. Canada's majority of its trade with the U.S. I believe I think it's 17 different states in the U.S. Their number one trading partner is Canada. So, tariffs. And we want the U.S. economy to do well long term, and we know long term these tariffs will support. For example, tariffs on copper is going to result in U.S. Mining and manufacturing starting back up for copper. So long term is going to be beneficial, but short term, this is hard on American manufacturing, including groups like us who do development. Now, for CPI, we're right in the crosshair because not only we want the success of U.S. economy, we also don't want prices to rise because of imported material costing more. It's going to result in our construction costs going up. So overall, I'm optimistic long term, but short term, we're definitely facing some difficulties.
No, I know. And that's why I asked the question. I had to ask the question. I know it goes a lot further than those Kentucky bourbons up there that they're putting on the bottom, or I don't even know, maybe they're taking them right off the shelves right now. But at the same time, it's one of those things. It's like, we've been such good trading partners, Canada and the United States, for so long. It'll still be fine. Short term, there's going to be a little angst and a little bit of pain. I will say this, though. Most of my holdings are down in Costa Rica, and the Canadians love to go down to Costa Rica. So they're just flying over the United States, and they're just flying down to my property down there in Costa Rica, which I appreciate.
There you go.
Yeah. Yeah.
Great.
Well, so just a couple of things. I want people to, number one, to be able to find you, to get information. I know you're a wealth of knowledge. You and I could probably talk for hours on this, but with the time we have, where do people need to go to get more information about you and what you do?
Absolutely. I'm very active on LinkedIn. I'm a LinkedIn top voice, which is invite only. So I'm boasting and bragging a little bit over here. But yeah, on LinkedIn, August Biniaz, reach out. Tell me you've seen me on the show. Happy to get on a call and, give you some time. Our website, cpicapital.com. Check it out. There's lots of great information there as well.
And then last thing, new investors coming in. I mean, we've been doing this for a long time, but these new folks that are coming in going, hey, I want to really go. I want to be good at this. I want to make a lot of money. I want to get good returns. What would be your one piece of, let's say, your best advice that you could give to somebody just coming into the business?
Yeah, it's difficult to give only one advice, but I
I
will
know.
summarize it. I think we touched on it a bit. Number one is immersion. If you believe in an asset class so much that you're going to invest in it yourself and you're going to invest your time in it, and then eventually you want to go raise money, you better be in some level an expert in that space. So immersion, with so much information and content available these days, like this great show that we're on today, get out there. Familiarize yourself with the asset class. Make sure you believe in it yourself. And the next step would be whatever asset class that you're interested in and you want to grow your portfolio is invest in it, not only as active investor, but possibly a passive investor that teaches you long-term of how these deals are put together. Join a mastermind. We touched on this earlier as well. A lot of these masterminds, and be selective. Join one that you can meet other great people there, potentially partners, and just do it. I mean, a lot of time people are also afraid. Like I was talking earlier, when you hear these large private equity firms and all these top talent that they that they source from around the world, it makes it a bit intimidating. But taking that first step is also very important. So, not to be afraid and be confident. Take the first step and invest and make the next move.
I love it. August, thank you so much for coming on today.
Thank you for having me.
Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training. an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertyexpertnetwork.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets Podcast.